Let's be completely honest with each other. Gold is the ultimate double-edged sword in trading. No other asset pair gives you 150 pips in 10 minutes while making you feel like an absolute genius when you're right. But on the flip side, no other asset pair destroys funded accounts, triggers revenge trades, and wipes out weeks of disciplined profits faster than XAUUSD. If you've been trading gold for any amount of time, you already know the story. You mark up your setup, everything looks clean, you enter a position, and within 3 minutes, the price moves violently against you. You panic, you close at a loss, or worse, you move your stop loss down just a little bit. 2 minutes later, the market sweeps your liquidity, hits the exact level you originally predicted, and blasts off to take profit without you in the trade. You sit there looking at your screen, angry, exhausted, and asking yourself, why does this keep happening to me? Is the broker hunting my stops? Is gold just completely unpredictable? Here is the cold, hard truth. Gold is not unpredictable, and the market isn't personal. The real reason you keep losing money on XAUUSD has almost nothing to do with your technical strategy. It has everything to do with how your brain reacts to gold's unique volatility and how your trading psychology gets systematically exploited every time you open a chart. In this video, we aren't going to talk about basic chart patterns or generic indicators. We're dissecting the exact psychological traps specific to XAUUSD that keep retail traders trapped in a cycle of losing money, and more importantly, the exact framework you need to break out of it. To fix your losses on gold, you first have to understand what makes XAUUSD fundamentally different from every other major pair like EURUSD, GBPUSD, or AUDUSD. Gold is a physical safe haven asset driven by global macroeconomics, institutional hedging, central bank liquidity, and real-time geopolitical sentiment. Because of this, its volatility, its average true range, is massive compared to standard currencies. A standard 20-pip move on EURUSD might take 2 hours of slow, grinding price action. On gold, a 20-pip move happens in 5 seconds on a random Tuesday morning. And that speed is where your psychological downfall begins. When you see big candles printing rapidly on your screen, your brain registers it as an emergency opportunity. Neurologically, your brain releases a spike of dopamine triggered by the fear of missing out, what we call FOMO. When you trade a slower pair like EURUSD, you have time to think. You analyze, you wait for candle closes, you check your risk model. But on gold, the speed tricks your nervous system into skipping your rules. You see a massive green 5-minute candle expanding, and your brain whispers, "Get in now or you're going to miss the entire move." So what do? You enter at the top of the expansion candle without waiting for a pullback. You enter without calculating your lot size properly. You jump into the market driven purely by emotion. And what happens next? The institutional algorithm finishing that expansion pulls back instantly to seek internal liquidity. The market retraces 30 pips against you in seconds. Because you entered late with a huge lot size, you're suddenly down hundreds or thousands of dollars before you even have time to process what happened. You didn't lose that trade because your analysis was bad. You lost that trade because you traded the speed of the candle instead of the structure of the market. You let the dopamine rush of gold's volatility override your execution system. If we audit your last 20 losing trades on gold, I can almost guarantee they fall into 3 specific psychological traps. Let's break them down one by one and see if you recognize yourself in any of these. First is the low time frame lot size illusion. Because gold moves so fast, traders love to zoom in to the 1-minute or 3-minute chart looking for quick scalps. There's nothing wrong with lower time frame entries if you have a strict risk framework. However, retail traders look at a 15-pip stop loss on a 1-minute gold chart and think, my stop loss is small, so I can use a 5-lot or a 10-lot position. They think smaller pip distance equals lower risk, but gold's noise on the 1-minute chart is constant. A simple 10-pip spread expansion or standard market breathing will wipe out a tight stop in an instant. When you stack massive lot sizes onto ultra-tight stops on gold, you aren't trading, you're gambling on micro noise. One minor retrace wipes out 3 to 5% of your account in a single tick. Second is the just 5 more pips delusion and revenge trading. Gold moves with immense momentum. When a trade goes into drawdown, it doesn't do it quietly, it pushes hard. When you see your open position negative on gold, ego takes over. You tell yourself, gold always bounces, let me just move my stop loss behind this next swing high. Or even worse, you remove your stop loss completely because you can't stomach taking a clear, defined loss on a volatile pair. Gold will happily trend 400 pips without giving a single deep pullback when institutional narrative is behind it. Moving your stop loss against a trending gold market is the fastest way to blow an entire account in a single session. And then comes the inevitable reaction, revenge trading. After gold stops you out or blows a hole in your equity, your ego feels violated. You instantly double down on your lot size, jump into a position in the opposite direction, and try to take back your money from the market. But gold doesn't care about your feelings or your lost equity. It eats revenge traders alive. Third is trading gold outside liquidity windows. Gold isn't an asset you can comfortably trade 24 hours a day with the same strategy. Trading gold during low volume hours, like the late Asian session or late US afternoon, is financial suicide for retail accounts. During these hours, liquidity is thin. Spreads widen significantly, and price action becomes choppy, unpredictable, and prone to sudden, random spikes driven by minor order flow. Yet retail traders sit at their desks at random times of the day, bored, feeling the urge to press buttons, trying to extract pips out of dead market conditions. Now that we've diagnosed the emotional disease, let's talk about how the market actually moves so you can shift your perspective from a retail victim to an objective trader. Institutions do not view gold the way retail traders do. Retail traders look at gold and see support, resistance, trend lines, and candlestick patterns. Institutions look at gold as a massive pool of liquidity and pricing inefficiency. Because gold attracts an incredible volume of retail stop losses placed right above obvious swing highs and right below obvious swing lows, it is the primary target for liquidity engineering. Before gold moves in its true intended direction, smart money must engineer liquidity to fill massive institutional orders. How do they do that? First, they push price past an obvious equal high or key resistance level to trigger all the retail sell stop losses and buy stop breakout orders. Once those orders are triggered and liquidity is captured, the market reverses sharply, leaving retail traders stuck in bad positions or stopped out entirely. Price then expands aggressively toward the real target. If you look at the price action on high-impact days, notice how price aggressively sweeps the previous daily high right at the start of the New York session. Retail traders see that massive bullish candle and buy the breakout. 5 minutes later, the market leaves a long upper wick, reverses completely, and drops 200 pips. If you don't understand that gold requires liquidity sweeps before real displacement, you will continuously buy the top of sweeps and sell the bottom of runs. You aren't losing because you're unlucky, you're losing because you are supplying the liquidity institutions need to enter their trades. If you want to stop blowing accounts on gold and actually build consistent profitability trading XAUUSD, you need to rewrite your entire approach. Here is the framework you need to implement starting today. Rule number 1, trade sessions, not charts. Gold lives and dies by institutional liquidity windows. Only trade gold during peak volume sessions, specifically the London Open and the New York session. If you are looking at 1-minute gold charts late at night when volume is flat, close your laptop. You are setting yourself up to be chopped up by spreads and algorithmic noise. Rule number 2, decouple lot size from emotion. Never select a lot size on gold based on intuition or confidence level. Whether you are trading a small personal account or a large funded account, your risk per trade should be fixed, ideally between 0.5% and 1% per trade. If your entry requires a wider stop loss on gold, your lot size must decrease. If your stop loss is tight, calculate your position size so that the total dollar amount lost remains exactly the same. When your dollar risk is fixed, a fast 30-pip drop against you won't cause emotional panic because you already pre-accepted the exact dollar loss. Rule number 3, wait for liquidity purges. Stop buying at key resistance expecting a breakout and stop selling at support expecting a crash unless a major liquidity pool has already been cleared. Before taking a buy setup on gold, ask yourself one question. Where are the retail stops resting and has price already swept them? If the answer is no, wait. Let gold purge the obvious retail levels first. The cleanest, highest probability setups on gold happen after the initial violent manipulation has already occurred. Rule number 4, enforce a 2-trade daily hard stop. Gold's volatility makes it exceptionally easy to slip into revenge trading. The best defense against this is an unbending operational rule, maximum 2 trades per day on XAUUSD. If you take 2 trades in a session and both hit your stop loss, your day is over, period. No one last trade to get back to break even, no increasing lot size. Turn off your charts, log the setups in your journal, and walk away. Protecting your mental capital is far more important than protecting any single trading day. Rule number 5, respect high-impact economic news. Gold is directly linked to the US dollar and macroeconomic indicators like CPI, NFP, and FOMC decisions. Executing trades seconds before a major news release on gold is not trading, it is pure roulette. Slippage will ignore your stop loss, spreads will inflate dramatically, and execution speed will fail. Unless your strategy specifically accounts for post-news narrative shifts once the initial spike clears, sit on your hands during high-impact red folder news events. Trading gold doesn't have to feel like an emotional roller coaster where you're constantly one bad trade away from blowing your hard-earned capital or prop firm account. XAUUSD is an incredible instrument. It offers pure liquidity, clear technical delivery, and unmatched opportunity. But it demands respect. It punishes greed, it exposes lack of discipline, and it relentlessly strips capital away from impatient traders. The next time you open your gold chart, don't look for the quick hit of dopamine. Look for patience, look for liquidity, look for structured execution. Ask yourself before every click, am I entering this trade because my system confirmed it during a high probability session, or am I chasing a fast candle out of fear? Master your psychology first, and the execution on gold will take care of itself. If this resonated with you or helped reframe how you look at trading XAUUSD, make sure to like and subscribe to the channel for more raw, honest trading insights. Drop a comment below letting me know the biggest challenge you face when trading gold. Trade smart, stick to your risk management, and I'll see you in the next video.